to a very special episode of Retiring Today. We've got a live studio audience with us. That's because we have a very special guest with us. We've got Marty Ruby. He's an author and a nationally recognized speaker. Join us right now for Retiring Today. Welcome to Retiring Today. This is a special episode because we have a very special guest. Let's introduce him. He's Marty Ruby. He's an author and a nationally recognized speaker. And this guy here, you recognize him. He's Loren Merkle. He's a certified financial planner, a certified financial fiduciary, and a retirement income certified professional. Loren, why is it so important to have Marty on the show today?
Well, I was first introduced to Marty a couple years ago. Marty, I ran across your book called The No Compromise Retirement Plan. Mm-hmm. And then recently you came out with the new book, which we have right here, The New Holistic Retirement. And I read these books and they're absolutely genius, because what I like about these books the most, taxes is a very complex subject. Molly, we spend a lot of time on this show talking about taxes and we try to break it down in a very simple way, but your books do really break it down in a simple way, and they provide examples that are a little bit different than the way that we would traditionally talk about taxes, tax strategy, and tax planning. So Marty made himself available to come here today to be on our show. Thank you very much, Marty. And we look forward to a really good conversation of not only how can tax planning play a role within your overall retirement plan, but we'll walk away with some very specific examples that you may be able to use right away to help save money in the form of your retirement tax bill.
Yeah, so Marty, let's learn just a little bit about you before we dive into this this tax strategy stuff.
Okay, great. I am from Louisville, Kentucky, native of Louisville, and actually my background is a little strange for writing books and speaking, public speaking and so forth. I'm an actuary. Now, most people don't know what an actuary is. Some have heard of it, they don't know what it is.
They like numbers, right?
We're like the math geeks of the insurance industry. We're the ones that do probability and statistical studies and determine premiums and develop new products. What we're really trained to do is analyze risk and then figure out, given these risks, how do we reduce or eliminate them? So in my 50-year career now, my job has been to identify risk in retirement savings and then figure out what do we do about those risks.
Okay, so let's dive right in. Let's talk about the biggest risk that you spend a lot of time in your books talking about, and it's taxes. We're going to get into it in more detail, but what we want to cover today is that there are 3 ways that taxes can go up in the future.
Right, and people really kind of to lay the groundwork, people don't realize it, but as they save for retirement, most people save in an IRA or 401k, a tax-deferred plan. You put money in, the account grows, but when you start taking money out, you're taxed on both what you put in and all that growth. Therefore, taxes is a huge determinant of how much of that money you end up keeping versus how much you have to pay in taxes. So we talk about in our books 3 ways that taxes could go up. One's the obvious one, tax brackets, tax rates go up. The other 2 aren't so obvious. One is that, particularly in the 2017 Tax Reduction Act that was passed, the deductions that you get on your tax return actually were reduced. So while tax rates went down, the amount of deductions you got also went down, which means you ended up paying lower taxes but on more of your income. And finally, the one I love to talk about is what I call stealth taxes. And those are taxes that are triggered, payments that are triggered to the government based on your income. So probably the best example of that would be Part B Medicare premiums. When you are on Medicare, you pay an insurance premium into the government every month on Part B Medicare. However, the size of that premium is determined by how much income you report. So the more income you report, the higher the payment. Now the government calls that an insurance premium, but most normal people would call that a tax. The more income you earn, the more you have to pay into the government. And I think these stealth taxes are a way that we're going to see in the future that more tax revenues raised without calling it a, quote, tax increase.
And Loren, looking at taxes, assessing taxes and assessing tax risks sometimes is the difference between the accumulation advisor and the retirement planner.
Yeah, it certainly can be. And there's nothing, I mean, the accumulation advisor is a really valuable resource during the accumulation phase of your life. So the difference is that an accumulation advisor most of the time will focus on the investment piece, right? What kind of risk are you taking? Here's the type of asset allocation that you want to have within your overall portfolio to accomplish the goals that you've laid out to that advisor. Whereas the retirement planner, and this is what we focus on here, is we focus on the holistic retirement plan. So we're talking about taxes and how you can mitigate the impact of taxation. And one of the things that you will notice as you make that transition from the working years to the retirement years, and you start to think about all these things in retirement that you've never really had to think about before, that it's not about what you make. It's about what you get to keep, and it's about what you get to spend, and that's how incorporating the tax planning into your holistic retirement plan can really pay big dividends to you as you go through the course of your retirement.
So we know that your plan is specific to you, your tax situation. So here's an opportunity to talk directly with a retirement planner about your specific situation. It's a 15-minute complimentary retirement checkup call. You can schedule yours right now by going to merkleretire.com and scheduling your 15-minute retirement checkup call today. Coming up, Marty Ruby talks about some of the solutions to this tax risk that can derail your retirement.
The Merkle Retirement Planning Team provides personable and professional expertise unrivaled in this area. They include us in every step of the planning process. The peace of mind provided to us by the Merkle team allows us to fully enjoy this special time of our lives. Instead of feeling snakebit, we feel confident that with the Merkle Retirement Planning Team at our sides, we can navigate any challenge that comes our way.
Merkle Retirement Planning. Your retirement starts here.
When planning a big trip, do you like to look up points of interest, read restaurant reviews, or map out how to take the scenic route? You may spend days or even weeks getting ready for a week-long vacation. What about the 20 or 30-year journey that is retirement? Join us for a complimentary online workshop, Journey to Retirement, December 14th at 6:30 p.m. What you can learn from the comfort of your own home in these online workshops will help you plan for the most exciting journey of your life. Register today at merkleplan.com.
A live studio audience with us today. That's because it is a very special episode of Retiring Today with Loren Merkle, because we've added this guy. It's Marty Ruby. He's a nationally recognized speaker and an author. And what we're talking about are taxes. And Loren Merkle, most people agree that taxes are probably going up.
If you look at the financial dynamics in this country, I mean, $28 trillion in debt, $3.5 trillion in annual deficit, record numbers that we've never seen before. With that, we also look at the national debt versus gross domestic product ratio. And the gross domestic product is the value of the goods and services that we produce in this country. So if we use that ratio, the highest that ratio has ever been, we have to go all the way back to 1946. Right past World War II, it was 106, that ratio. Right now, that ratio is 126%. And there was a study that was conducted based on this ratio, and the study says is that if we stay for an extended period of time over 77%, that our economy is going to start to slow down. So that ratio is signaling alarms, and most people, as you mentioned, Molly, think tax rates are going to go up. I mean, there's 10,000 people retiring every single day. The vast majority of those people retiring have most of their retirement savings in these accounts that they've never paid taxes on before. So if we are thinking like the IRS, which I know is a little hard.
Thinking like the IRS?
If we're thinking like the IRS, we have these big numbers that we have to cover. What's the easiest way to cover those big numbers as far as debt and deficit?
Taxes.
Well, we got all these people retiring. When they retire, they need to take money out. If they don't want to take it out, they're forced to take it out at the age of 72, which is a big revenue generation opportunity, especially if taxes go up.
Yeah, and in your book, Marty, The New Holistic Retirement, you show how powerful this tax risk is in numbers.
Right. And this is something I really wanted to educate people on, because most people have saved tax deferred. And I call it a kind of a hidden debt that they have on their balance sheet that they don't even realize it as embedded in their IRA. So what we have done is we've developed a report, and Loren and his team have access to this report, and you can get your own run, but I'm going to show you an example of how we look at the taxes you're going to pay over your lifetime because of how you saved. You saved in a tax-deferred plan, therefore, kind of what have you gotten yourself into in terms of tax liability? And this question, I think we were one of the first people to actually ask and answer this kind of question. So let me kind of go over briefly how this report works. In this example, we have a person who's about to retire. He has a $700,000 IRA, all tax deferred. And we look at, for the rest of his life, and we assume he lives to age 90, what taxes will he have to pay over his lifetime if he just stays in that tax deferred IRA? And we look at three different sources of taxes. One is the taxes on what are called required minimum distributions, RMDs. Starting at age 72 under current law, the IRS requires you to start taking money out of your IRA because they want you to start paying tax on it. So you have to take income out whether you want to or not, and you pay tax on it because it's now taxable income. So that's one part of, if you will, this projection. The second part is, in this first model we developed, is kind of what I call a savings model. The second part is we take those RMDs that you have to take out at age 72 and beyond, pay tax on them, and we reinvest those RMDs in a taxable account. Because once money's out of your IRA, you can't put it back in. It's no longer sheltered. And finally, the third kind of tax we look at that's driven by your IRA is the tax that beneficiaries have to pay. And these kind of break down into two parts. One is if you leave your IRA to your kids or your grandkids. And I always like to tell people this is not much of a legacy because you're leaving a gift with strings attached. Because what happens is now they have to pay tax on the IRA. You don't get out of paying tax, well, you can get out of paying taxes by dying, but your kids don't. They have to pay tax on that inherited IRA. So it's a legacy with strings attached. And in fact, if you think about it, it's kind of an unfair tax because you got the benefit of the deduction and now your kids have to pay tax on that money coming out. But the other way that these inherited IRAs are taxed are really the more serious one. And that is when you think about a married couple, they're filing most likely a joint tax return. After the first spouse passes, the surviving spouse now the year after has to start filing as a single taxpayer. Single taxpayers pay much more tax on the same dollar of income than joint taxpayers. So think about what's happened here. One of the spouses passes, the next year the surviving spouse on the exact same IRA distribution has to pay more tax. Now, critics have called this the widow's penalty because actuarially, men die sooner than women, and so often the widow is sitting there now with the exact same IRA. It hasn't changed, but guess what? All of a sudden taxes go up just because you're leaving that behind a tax-deferred account as opposed to something else. But that's how most people do it, so that's kind of what the model assumes. So what we've done in this example is we've taken a $700,000 IRA, and we made a couple simple assumptions. And when Loren run these numbers for you, you can make your own assumptions. But for this, we've assumed 25% total taxes, state and federal, and the account would grow 5% a year. Very simple. And so we run our numbers and we say, what kind of taxes are we going to generate between now and age 90 in this example because you've saved tax deferred? So from RMDs alone, you'll see that it's $230,000 of taxes you pay over your lifetime from retirement on, if you will. These reinvested RMDs after tax that you can no longer shelter generate another $101,000 of taxes. And finally, because the IRAs continue to grow, when you die, the heirs, whether it's your spouse or your kids, there's another $160,000 of taxes. So for a $700,000 account over your lifetime, you're going to generate $492,000. Let's call it $500,000 of taxes. So when you think about it, when you look at this number, and by the way, the first time I ran this model, my jaw dropped. And I actually had some CPAs check my math to make sure this was the right way to do it. And they both agreed this is IRS math, if you will. So what you begin to realize is you've been saving for decades. A lot of that saving up until now has been used to pay taxes. So then you kind of ask yourself, well, isn't there a better way? This seems like a huge dollar of taxes to have to pay. And by the way, this doesn't even assume taxes are going up. This is just kind of current taxes. So you kind of look at the Internal Revenue Code. As you can tell, I'm a big believer, and you'll see in my books, you got to look at the tax code to understand the best way to save for retirement. Now, the tax code does offer one alternative, well, actually several, but one that we'll look at in this model is what's called a Roth conversion. A Roth IRA is when you pay tax up front, you put after-tax dollars in the Roth, but then it's allowed to grow tax-free, so when you take money out, pass it on to heirs, there's no more tax. A Roth conversion is when you take an existing IRA, get the tax out of the way today, while presumably your account's lower and taxes are lower, and then you let everything grow tax-free. So on a Roth conversion, you take that $700,000, you pay off the tax you already owe, the $175,000 in this example, but then everything grows tax-free. So what you've done is you've reduced your tax payments from $492,000 to $175,000. Now, as I like to point out to people, the $175,000 is a mandatory tax. It's there because of how you saved. The difference between the $492 and the $175, that's optional. If you just don't take any action today, you'll end up paying that optional tax. If you take some actions today, there's a way to eliminate that optional tax.
And that is a very powerful strategy. We'll talk about how to assess if that strategy is right for you when our special Retiring Today continues.
When planning a big trip, do you like to look up points of interest, read restaurant reviews, or map out how to take the scenic route? You may spend days or even weeks getting ready for a week-long vacation. What about the 20 or 30-year journey that is retirement? Join us for a complimentary online workshop, Journey to Retirement, December 14th at 6:30 p.m. What you can learn from the comfort of your own home in these online workshops will help you plan for the most exciting journey of your life. Register today at merkleplan.com.
The Merkle Retirement Planning Team provides personable and professional expertise unrivaled in this area. They include us in every step of the planning process. The peace of mind provided to us by the Merkle team allows us to fully enjoy this special time of our lives. Instead of feeling snakebit, we feel confident that with the Merkle Retirement Planning Team at our sides, we can navigate any challenge that comes our way.
Merkle Retirement Planning. Your retirement starts here.
Welcome back to Retiring Today. You just saw a shot of our amazing live studio audience. They are here today because we have got a fun show. Loren Merkle is here, and we've got a special guest. He's an author and nationally recognized speaker, and his name is Marty Ruby. And those amazing audience members, well, one of them, Timon, has a question.
Thank you. Reference the Roth conversions. Should you do that before you start Social Security or after? For us that are right there at that cusp of retiring or we're getting close to retirement, so should we convert before we start Social Security or after?
Actually, it's independent of when you convert to Social Security. What you're really looking at Roth conversion is to say, I want to get out of the risk of future tax increases, so you get it done now while tax rates are lower, and I want to get it done when my account's smaller, because it's just less dollars I have to pay tax on. So it really doesn't you don't have to coordinate it with when you elect Social Security. It's really more of future tax risk, and you want to eliminate that risk, and one way to do it is a Roth conversion.
Okay, we've got another studio audience member with a question.
My husband and I are getting real close to retirement, and pretty much all our funds are non-taxed from 401ks at work. Would it be better to wait until you are retired, where I think our bracket would be going down as far as money earned, and would that be of advantage?
Yeah, I love that question. It sounds like you're in a similar situation as most pre-retirees, where most of your retirement savings is in this account or accounts that have never been taxed before. So the big question is, do you convert now? Do you convert later? What does that look like? What we have always been told is that when we retire, we are going to be in a lower tax bracket. Now, for some people, that's true. But for a lot of people, that is not true. Or you're going to be in a lower tax bracket in retirement for a few years until you get to RMD age. So at RMD age, you're mandated, whether you want to or not, to start taking distributions from these accounts that have never been taxed. So at that point in time, you really lose control over what tax bracket you're going to be in. Because if you have a pension by the age of 72, which is RMD age now, You've turned that pension on, you can't turn it off, you don't want to turn it off. You've already turned on Social Security, you're not going to turn it off, you don't want to turn it off, you can't turn it off. So you have this baseline of income that the vast majority of it with the RMD is going to be subject to tax. And for many retirees, that does elevate the level of tax bracket that you're in, and that's just assuming tax brackets stay the same. So for many retirees, once you hit RMD age, you're going to be in the same or maybe even higher tax bracket than what you were when you were working. So this is where the independent customized analysis comes into play to look at what you would pay on Roth conversion money today while you're still working versus what you would pay once you recently retire, and then what you would pay even post RMD age. And when you see the results of that analysis, then that answer becomes very clear. But the actual specific answer is different for everybody based on your situation, which is why that analysis is so important.
Well, before we took a break, Marty showed us a really powerful example, Loren. $492,000 in taxes versus $175,000 in taxes. Sign me up for the 175.
Let's do the 175 all day long. Yeah, and what I really liked about that in the program that you have, Marty, is it gives a visual. It gives a visual to answer that question that Jan just had, is what makes sense, when should we do a Roth conversion? And what one of the big questions we get all the time is, do I do the Roth conversion now? Do I do it later? Do I never do it? The answer is different for everybody. But going through this analysis, you can identify in a quantifiable way what happens if you take no action. What are you going to pay from a tax standpoint? And then what happens if you do take action? What are you going to pay from a tax standpoint? And then again, it becomes very clear. And as you were going through that example, there was a lot of heads nodding in the live studio audience, which tells me they got it, right? So this is just one way that Marty makes it very simple, clear, concise to understand. And it's one thing for us to say, yes, Mr. and Mrs. Jones, you should do a Roth conversion, but it's another thing for you to see it.
And another question we got when we were chatting during the break, Marty, was any limits on the Roth conversion?
Right. And currently there are no limits on Roth conversions. However, there's a lot of discussion in Congress. And this is kind of amazing as they debate different ways to raise revenue to cover all this extra spending they want to do. There's a lot of debate now about limiting growth in IRAs, limiting Roth conversions, just putting all kind of limits on tax advantage retirement savings. So again, I emphasize in our book, legislative risk is something that you have to be cognizant of. We have a saying that, in terms of retirement savings, tax legislation is written in pencil. It can change every 2 years. And I might point out, it's not just what's going to happen in the next year or so. You can live 20, 30, 40 more years in retirement. You got to think the long term and what might happen then.
Yeah, you talk a lot about the long game in your book, but you also say, to end many of the chapters, take action now. What do you mean by that?
Well, it's too much, it's so easy to just kind of do what you're doing. Inertia is kind of human nature, if you will. But I think, and one of the reasons we've designed these series of reports for people is we want to shake them up. We want to say to people, here is the cost of procrastination. And that's why I contend advisors like Loren, and we work with advisors like this all over the country, I emphasize, come in and look at your numbers and then decide what's best for you and your family. But you'll see that little changes now can make huge differences later on.
And that's the big key. Most of the best tax planning strategies you have to implement by the end of the tax year. So by 12/31, December 31st, you have to implement these strategies. You cannot wait until the spring when you file your taxes if you want to implement these strategies for this current year. And that's why I say every 12/31 that goes by that you do not do this type of analysis is a wasted opportunity to take advantage of this, because right now we're in a historically low tax rate environment. We think it's going to go up. We don't want to wait 3, 4, 5 years to start looking at this because we missed out on a lot of opportunity.
Yeah, so there is an opportunity to take action right now, and you could have a retirement planner look at your tax bill. Right now we are offering a complimentary tax bill analysis, and if you schedule a tax bill analysis by using the website that you're seeing on your screen right now, we will also include a complimentary copy of Marty's book, The New Holistic Retirement. So Loren and Marty, I'm coming in, I want a tax analysis, I want to save, $300,000 on my tax bill on an IRA. What are we going to look at? What do I need to bring? What are we going to do?
Well, first of all, you have to bring in all your financial records. You want to look at all the assets you have, because everyone can affect the overall analysis. So bring in that, but also be prepared to talk to Loren and staff about what are some of your plans? What are some of your needs in the future? What are your expenses expect to be in retirement? What kind of income are you needing to live on? And one of the things, by the way, and I want to emphasize something that Loren said, people think, well, I retire, all of a sudden my income needs are a lot less. And our experience is, in fact, you don't want to reduce your standard of living. So maybe you're used to X income while you're working. I'm not so sure you don't also need X income when you're retired. So I wouldn't bank on all of a sudden dropping several tax brackets just because you're retired. Our experience is, at least with us, the baby boomers, we want to lead a good life in retirement. And so you got to think through those issues and kind of be prepared to address what's going to go on in the future.
And the tax analysis is a great way to take action.
It definitely is, because then you can see for yourself what it looks like if you don't take action versus taking action, and then this decision that you have to make from a tax planning standpoint becomes much easier. And that's really what the whole retirement planning process is about, is to help you make these permanent decisions that you've never had to make before, and make them in a confident way, so 5 years, 3 years, 4 years down the road, you don't have to look back and say, I wish I would have.
And this is just part 1 in a 2-part series with Marty Ruby. So you're going to want to watch part 2. So here's how you can do it. You can tune in where you're watching now, or you can go to our YouTube channel. It's Merkle Retirement Planning, but there's a lot more to talk about when it comes to living out your retirement vision. We thank you for watching.
The Merkle Retirement Planning Team provides personable and professional expertise unrivaled in this area. They include us in every step of the planning process. The peace of mind provided to us by the Merkle team allows us to fully enjoy this special time of our lives. Instead of feeling snakebit, we feel confident that with the Merkle Retirement Planning Team at our sides, we can navigate any challenge that comes our way.
Merkle Retirement Planning. Your retirement starts here.
Thank you so much for watching Retiring Today. We hope you've enjoyed the show.
See you next week.